All right, so you're ready to dive into the world of ETFs.
Sounds like it.
Yeah, and specifically, you're interested in SCHD and SCHG.
Two of the heavy hitters out there.
Yeah, for sure. And, I think we can all agree that picking the right investments,
It can be overwhelming.
yeah, it really can be.
There are so many choices.
There are so many options out there.
Yeah. And figuring out,
Exactly. Figuring out where to even begin.
it can feel impossible.
It really can. So that's what we're here for today.
We are. To break it down.
To break it down and
Not that simple.
make it simple and help you decide if either of these, or maybe even both,
Both.
are a good fit for you.
That's right. Yeah.
Right. So I think it helps to start with a story.
Okay. I love stories.
Me too.
Yeah.
So imagine two people. We'll call them Sarah and John.
Okay.
They both love their daily coffee.
Who doesn't?
I know, right? But Sarah, she decides to skip her latte every day
Okay.
and instead invest that $5 into the market.
All right. So small little steps.
Small little steps, right? Now, John, he enjoys his coffee a little too much.
Okay. I see where this is going.
I think you do.
Yeah.
He keeps buying those lattes.
No judgment, but if I...
No judgment, but let's see what happens after a few years.
Okay.
Fast forward, and guess what? Sarah's small, consistent investments.
Have grown. The magic of compounding.
Exactly. The magic of compounding.
Yeah.
It's pretty amazing, right? John, though, he's still enjoying his coffee.
But maybe wishing he'd put some of that money aside.
Maybe. Now, this story is really about the power of starting early.
And staying consistent.
Absolutely.
Even small amounts can add up over time.
Exactly. And that's what we're talking about today with these ETFs.
SCHG and SCHG.
Yeah, they can be powerful tools.
For sure. For building long-term wealth.
Yeah. And they make investing accessible.
Totally. Even if you don't have a ton of money to start with.
Yeah. So I know a lot of our listeners are probably already familiar with what an ETF is.
The basics.
Yeah, the basics, yeah.
Yeah.
But for anyone who's new, maybe just a quick refresher.
Sure. So an ETF, it stands for Exchange Traded Fund.
Right.
And essentially, it's like a basket of stocks.
Like a prepackaged portfolio.
Exactly. Instead of buying individual stocks.
You're getting a slice of many companies all at once.
Exactly. Diversification in a single investment.
So less risk than putting all your eggs in one basket.
Exactly. And the beauty of ETFs is they trade on the stock market,
Just like any other stock.
making them super easy to buy and sell.
So that's your ETF crash course.
Crash course complete.
Okay, so we know SCHD and SCHG are both ETFs, but that's kind of where the similarities end, right?
Yeah, they actually have very different approaches
Different approaches.
to investing. Yeah.
Okay, so how so?
Well, SCHD, it's all about dividends,
Dividends.
while SCHG focuses on growth.
Growth. All right. So two different philosophies.
Two totally different philosophies, and those philosophies translate into the types of companies.
That they invest in.
Yeah. So with SCHD,
Got
you're essentially investing in what are called dividend aristocrats.
dividend aristocrats.
It sounds fancy, right?
It does sound fancy. What does that even mean?
Yeah, it basically means these are companies with a proven track record
Okay.
of not only paying dividends, but actually increasing those payouts.
Increasing.
Every year.
So they're sharing their profits with investors.
Exactly. They're committed to returning value to their shareholders.
Okay, so not just any company paying dividends. It's about consistency and growth.
Exactly. Think of it as a seal of approval for stability and strong management.
I like that. A seal of approval.
Yeah.
So who are some of these dividend aristocrats?
Well, in SCHD, you're getting companies like PepsiCo,
Oh, yeah.
Coca-Cola, Johnson & Johnson, even Home Depot.
Big names.
Huge names, leaders in their industries.
Yeah, I see a theme here. They're all established, well-known companies.
Exactly. These aren't the flashy up-and-coming startups.
Right, not necessarily the next big thing.
Right.
More like the companies that have already proven themselves.
Yeah, they've weathered economic storms
Exactly. Been around for a while.
and emerged even stronger.
And are still going strong.
Exactly. And that's a big part of SCHD's appeal.
Stabilities.
Stability, reliability.
Makes sense.
Yeah.
But how does that actually translate into returns?
Right, that's the key question.
Yeah, are we talking about substantial income here?
Well, it's important to remember that dividend yields, they can fluctuate,
Right, of course.
but historically, SCHD has offered a yield that's significantly higher
Yeah.
than the broader market.
Okay, so that's pretty attractive for income-focused investors.
It is. And when you factor in the potential for those dividends to grow over time,
There's that compounding again.
yes, the magic of compounding.
It can really boost those returns over the long haul.
Exactly.
All right, so SCHD sounds like a pretty solid option for those seeking steady income.
It definitely has its strengths.
Yeah, but now let's flip the script and talk about SCHG.
Okay, time for the growth story.
This one's all about chasing those high-growth companies.
Absolutely. If SCHD is the tortoise, SCHG is definitely the hare.
I like that analogy. So we're talking about companies with disruptive potential.
Exactly. Companies that are pushing the boundaries, transforming industries.
Okay, give me some examples. What kind of companies are we talking about here?
Think Tesla, Amazon, Google. These aren't just playing the game.
They're changing the rules.
Exactly. They're reshaping the future.
So instead of those established giants, SCHG is betting on the innovators.
Exactly. The ones who could be the next big thing.
That's exciting, but also sounds a bit riskier.
It definitely comes with higher risk.
Because these companies, their future isn't always a sure thing.
Right. It's a bet on potential, not necessarily proven success.
Okay, so with SCHG, you're aiming for those outsized returns,
Potentially massive growth.
but you're also accepting more volatility.
More ups and downs along the way.
Got it. So SCHG is for those with a higher risk appetite.
And a longer time horizon.
They can ride out those market swings.
Okay.
All right, so we've laid out the two philosophies. Steady dividends with SCHD, high growth with SCHG.
Mm-hmm.
But I think it's time to look under the hood a bit.
Get into the details.
Yeah, what about the specific holdings?
And the strategies behind them.
How do they actually pick the companies that go into these ETFs?
Right, good question. So with SCHD,
Okay.
it tracks what's called the Dow Jones U.S. Dividend 100 Index.
Okay, a mouthful.
I know, right? But basically, it's designed to hold those reliable dividend payers.
Okay.
Companies with a history of financial strength.
So it's not just about chasing the highest dividend yield.
It's about quality and sustainability.
Makes sense. Now, what about SCHG? How does it choose its companies?
SCHG tracks the Dow Jones U.S. Thematic Market Neutral Low Beta Growth Index.
Wow, that's even longer.
I know, a real mouthful.
So what does that actually mean in plain English?
Essentially, it means SCHG is looking for companies that are exhibiting high growth characteristics,
Okay.
regardless of their sector.
So it's casting a wider net.
Exactly. SCHD is more concentrated.
In certain sectors.
Right, like consumer staples, industrials.
The more established sectors.
Exactly. But SCHG, you'll find holdings in tech, healthcare, consumer discretionary.
So wherever growth is happening.
Precisely.
Interesting. So SCHD is focused, SCHG is more diversified in that sense.
You got it.
Okay. But let's be honest, everyone wants to know about performance.
Of course. How have these ETFs actually performed?
Yeah. Has SCHG's growth focus led to higher returns?
Well, remember, past performance isn't a guarantee of future results.
Right. Of course.
But looking back can give us some insights.
I'm all ears.
Both SCHD and SCHG
Yeah.
have delivered impressive returns over the past few years.
That's good to hear.
It is. But they've done it in different ways.
Different paths to success.
Exactly. So SCHG being more growth-focused,
Yeah.
it's experienced higher volatility.
More ups and downs.
Exactly. But overall, it's also had higher returns.
Makes sense. Higher risk, higher reward.
Right. Now, SCHD, on the other hand,
Yeah.
it's delivered smoother returns.
More consistent. Exactly. Less dramatic swings in value.
So it's weathered the storms a bit better.
You could say that.
Okay, that makes sense, given its focus on those more stable companies.
Exactly.
All right, so SCHG has potentially delivered higher returns,
Historically, yes.
but it's also come with more bumps along the way.
Right.
And SCHD, smoother sailing.
But potentially lower returns.
Right, gotta love that risk-reward trade-off.
It's always there.
Always. Okay, now you mentioned fees earlier.
Right.
And I know those can really eat into returns over time.
They can. Fees are important.
Yeah, for sure. What about SCHD and SCHG?
Good news. Both have super low expense ratios.
Oh, that's great to hear.
It is well below the industry average.
So we're not losing a chunk of our returns to fees.
Exactly.
Okay, so we've covered a lot. Strategies, holdings, performance, fees.
We're getting a good picture.
Yeah, starting to see how these ETFs work.
Yeah.
But I know what everyone's thinking.
Yeah, which one's right for me?
Right. Which one's the best fit? The million-dollar question.
It is. And I'm sure the answer is, it depends.
It always depends.
On your individual circumstances.
Right, exactly. Your goals, your risk tolerance, your time horizon.
Right, everyone's situation is different.
For sure. So let's imagine you're a younger investor, just starting out.
Okay.
You probably have a longer time horizon.
More time to ride out those market ups and downs.
Exactly. And you might be more comfortable with a little risk.
Yeah, makes sense.
In that case, SCHG, with its focus on growth,
Could be a good fit.
it could be. Those high-growth companies could really boost your portfolio.
Over the long term.
Exactly. Now, on the other hand, let's say you're closer to retirement.
Okay, different priorities.
Very different. Preserving capital becomes more important.
And generating income.
Exactly.
Yeah.
You're probably less interested in those high-flying growth stocks.
Right, you need that stability.
Exactly.
Yeah.
So, in this case, SCHD
With its reliable dividends.
could be a better choice.
Okay, so it really comes down to your individual circumstances.
It always does.
But here's a thought I've been having.
Okay, I'm listening.
Do you always have to choose just one?
Ah, good question.
Could you maybe hold both SCHD and SCHG?
Now you're thinking like a true investor.
How?
Diversification is key.
Right, exactly. It's not about picking one winner.
It's about building a portfolio that works for you.
So you could have that core of stability with SCHD
Your solid foundation.
and then maybe a little bit of SCHG for growth potential.
A bit of spice.
Exactly. So even if the market gets bumpy,
You have that stability to balance things out.
that makes a lot of sense. So it's not either
It's about finding the right mix.
the right blend for your goals
Exactly. And remember, that mix might change over time.
as your circumstances evolve.
You might shift more towards SCHG as you get closer to retirement.
That makes sense.
It's all about staying informed and adjusting as needed.
Well, this has been a fantastic deep dive.
I agree. We've covered a lot.
SCHD, SCHG, dividends, growth, diversification.
It's been a whirlwind.
It has. But as you continue your investing journey,
Yes, the journey is just beginning.
I want to leave you with this thought. Don't let the fear of making the wrong choice hold you back.
Paralysis by analysis, it gets us nowhere.
Exactly. Both SCHD and SCHG offer incredible opportunities.
For building wealth over time.
The key is understanding your goals and your risk tolerance.
And finding the right balance for you.
So keep learning, keep exploring, and most importantly, take action.
Get started, even if it's with a small investment.
Exactly. The first step is always the hardest.
But it's the most rewarding in the long run.
Well said. Thanks for joining us on this deep dive.
It's been a pleasure.
And to all our listeners, remember, knowledge is power.
Empower yourself and invest in your future.
Until next time.